Most people are staring at the price chart, wondering why Bitcoin feels stuck in the mud while the stock market is raging. But if you look away from the candles for just a second and look at global liquidity, something massive just happened. Bitcoin has not been this undervalued against global money supply since the absolute bottom of the bear market in 2018. We are sitting on a powder keg of data that suggests the next leg up isn't just possible, it is mathematically probable. But there's a catch. We are dancing right on the edge of a critical support level at $84,000. If this breaks, the structure changes. Today, I'm going to show you exactly why I'm buying this fear, where my invalidation line is drawn in the sand, and why, despite the boredom, my goal remains simple: to end the year with more Bitcoin than I started with. Right now, Bitcoin is trading in that frustrated zone between $87,000 and $89,000. Sentiment is a weird mix of boredom and anxiety. You have probably seen the posts, people asking if the cycle is broken or if they should just sell everything and buy Nvidia. Speaking of Nvidia, here is a reality check. Bitcoin is now officially less volatile than Nvidia. Let that sink in. The asset class that Wall Street used to call rat poison is now behaving more like a matured institutional asset than the leading tech stock. This stability is boring for day traders, but for position traders like us, it is usually the calm before the storm. We have been chopping sideways for weeks, effectively compressing the energy in the market. But while price action is sideways, the on-chain data and the macro signals are screaming something very different. There is a disconnect between price and value right now, and usually, price eventually has to run to catch up with value. Let me show you what the smart money is looking at while retail investors are getting bored. Let's start with the floor. Why has Bitcoin refused to drop significantly lower despite the weak sentiment? Look at the average cost basis of US spot ETF deposits. It is currently sitting around $83,700. This is not a random number. This is the same level we bounced from back in April. It suggests that 83,000 is effectively the institutional floor. As long as we hold above this level, we are essentially building a base on top of billions of dollars of institutional capital. And speaking of institutions, look at the IBIT flows. Eric Balchunas pointed out that despite IBIT having a negative return year-to-date, it is still 6th on the 2025 flow leaderboard. Think about the conviction required to pour $25 billion into an asset that is in the red for the year. That is what we call high-conviction holding. Now, zoom out to the macro cycle. There is a narrative that the 4-year cycle is dead. But if you overlay Bitcoin's price with the ISM Manufacturing Index, the business cycle, you see a perfect correlation. Halvings do not create bubbles in a vacuum. Global liquidity and business cycles do. We are seeing a bottoming in the business cycle, which historically aligns with a massive expansion phase for risk assets. We also have a rare signal on the stochastic RSI for the 10-year yield curve. The last 3 times we saw a bullish crossover here, a massive Bitcoin bull run followed. The 4th crossover just happened. However, we have to address the risk. Ray Dalio recently commented that central banks are unlikely to hold Bitcoin significantly because it is too transparent and hard to control. While that is a valid regulatory concern long-term, in the medium term, the hash rate is telling us the network is the most secure it has ever been. We are seeing hash rate hit new highs, meaning miners are investing in hardware, betting on higher prices, not lower ones. Finally, look at the RSI data from Global Macro Investor. The last 5 times Bitcoin's RSI hit this low level, price surged 100% shortly after. If history rhymes, that puts $180,000 on the horizon. But fundamentals are just the fuel. The technicals are the engine. Let's go to the chart. I'm looking at the weekly time frame. This is the one that matters for us as position traders. First, let's look at the market structure. We have been respecting a clear ascending channel for over a year, ever since late 2024. We are currently testing the lower boundary of this channel. To me, this looks like a classic bullish continuation pattern, but we are definitely in a fight for control right here at the bottom of the range. Now, look at the moving averages. The price is currently sandwiched. We are trading above the 100 EMA, that is the yellow line, and the 200 SMA, the green line. This confirms the long-term trend is still bullish. However, we are currently below the shorter-term moving averages, the 10, 21, and the 55 EMA, which is that purple line. These are acting as dynamic resistance overhead, pushing price down. We need to reclaim that 55 EMA to confirm momentum has shifted back to the bulls. Let's talk about specific levels using Fibonacci retracements. I have anchored this from the high of $107,000 in December down to the low of $77,000 in March. Our immediate support is the 236 Fibonacci level at roughly $84,000. This lines up perfectly with that ETF cost basis I mentioned earlier. This is the line in the sand. On the upside, our major resistance is the 618 level at 95,000. That's where we faced rejection previously. If we break that, the door opens to the highs. But the most compelling thing on this chart is the indicator at the bottom, the Heikin Ashi RSI. It is showing extreme oversold conditions. It has been a long time since we saw it this beaten down. I have drawn white circles in the indicator and in the price action to show that often, when the indicator is this oversold, price tends to go up. Now be careful here. As you can see from the white circles, sometimes there is a few weeks of lag. It doesn't always happen instantly, but the probability is heavily skewed to the upside. This brings me to my personal rule. I always nibble in oversold conditions and nibble out on overbought conditions. Even though I'm an eternal accumulator, and I have been since 2020, I trade around my core position. My philosophy is simple. At the end of the year, you must always have more Bitcoin than you started the year with. This oversold reading is exactly where I look to add to that stack. Here is my strategy based on this data. I'm treating the zone between 83 and 93,000 as my primary load zone. I'm a buyer here because the risk-to-reward ratio favors the upside. I'm betting on the channel support holding. However, as a disciplined trader, I must have an invalidation point. My stop loss is set at $76,000. If we get a weekly candle close below 76,000, it invalidates this specific ascending channel setup for me. It does not mean Bitcoin is dead. I'm a long-term holder, so for me, lower prices are just accumulation opportunities for the future, but for the short-term trade, I would be out. For my take-profit targets, I'm using the Fibonacci extensions. My first target is a retest of the highs at $107,000. My second target is the 1618 extension at $125,000. And my final stretch target for this move is the 2618 extension at $155,000. I'll be using a trailing stop strategy. If we hit 107,000, I move my stop loss to my entry. If we hit 125,000, I move my stop to the first target. This guarantees profit while leaving exposure for a parabolic run. So here's the game plan. We are at a decision point. The bullish case is that the $84,000 support holds, driven by that institutional floor and the oversold technicals. In this scenario, we grind back up to $95,000, break the 55 EMA, and challenge the highs. This is my base case, giving us a clear path to six figures. The bearish scenario is a volume-backed break below the ascending channel and a weekly close below $76,000. If that happens, I'm looking at a secondary accumulation zone much lower, likely between $60,000 and $70,000. I need to stress something vital for those of you holding altcoins. Remember that in order for our alts to pump, Bitcoin has to remain strong. If not, all of them will bleed until BTC finds strength again. It is essential to understand Bitcoin and macro moves to position accordingly. Don't ignore the Bitcoin chart just because you hold alts. Because of this necessary caution, my allocated portfolio right now is 40% Ethereum, 30% Bitcoin, 10% Solana, and 20% in the specific altcoins mentioned here in the channel. I'm heavy on the majors until Bitcoin proves it has finished this correction. The data suggests Bitcoin is undervalued relative to global liquidity, and technicals are flashing a rare oversold buy signal within a bullish trend. I'm betting on the structure holding, nibbling in while others are fearful. If you found value in this breakdown, make sure to like the video and subscribe. I post updates like this every single day to keep you ahead. And hey, if you want these charts and my moves in real time before the video drops, join my free Telegram community. The link is in the pinned comment below. I also covered Uniswap's critical support level in yesterday's video, so if you hold or like Uni, you definitely want to watch that breakdown on your screen right now. Never financial advice, and I'll see you there.